Hey, it's the weekend. News Radio 600 Kogo, Sully here. It's San Diego Business Saturday. Coming up on the program, Christina Gustin, UBS RKG Wealth Management, is going to walk us through the markets this week. Also, Patrick Dehaan, Senior Petroleum Analyst for GasBuddy.com. San Diego Business Saturday is on the air. So, wow. Are you is anybody still invested anymore? Or have you run for the hills at this point? I think it's a fair question because we saw some of the greatest volatility that we've seen in a year anyway on the markets, especially starting in the beginning of the week. You may recall that stocks suffered their biggest one-day decline of 2019 on Monday as China allowed its currency to fall. And it fell to more than a 10-year low versus the dollar after President Trump rattled the markets by announcing last Friday, not yesterday, but last Friday, a 10% additional tariffs on $300 billion worth of Chinese goods. So that rout, that one-day sell-off, marked the biggest, in percentage terms, the biggest sell-off for the Dow since December 24th. And we'll show this, and I'm sure I'll repeat myself on that, but we'll show the chart of that. You can go to kogo.com, keyword Sully. And as always, after the program today, after 10 a.m., mean producer Lady Mary will have posted up at kogo.com, keyword Sully, the television version of San Diego Business Saturday you can watch right there on the Kogo website. So China responds to the U.S. tariff threat, which is basically what Donald Trump had tweeted, by letting the yuan, which is a renminbi currency, so when you hear renminbi or yuan, it's the same thing. They let the yuan sink below 7 yuan per dollar for the first time in more than a decade. Now, let me explain how this works. All currencies are not the same. And I know many of you understand what I'm talking about, but let's break it down to the lowest common denominator. Let's just say we have a young person or an inexperienced investor wanting to understand this. 1 peso does not equal $1. 1 euro does not equal $1. 1 franc does not equal, let's be a euro. But the long story short is the euro, the yen, the British pound, the yuan, and the dollar, among many other, are on the international currency exchange. So you can trade those dollars back and forth. So China, when I say China let their yuan sink, it means that they artificially depressed their currency. And you can't just do that by doing a press release and saying, hey, dollar's only worth 80 cents now. That's not how it works. I'll tell you how they are gaming the whole trade deal by manipulating their currency. They're basically buying U.S. dollars with their own currency on this international currency market, and they drop their prices in response to the Trump tariffs. Now, I don't know where to begin here, but just to clarify, and I want to be very clear about this, China isn't paying these tariffs. Importers are. Governments don't pay these things. Importers do. And potentially you and I do. So why would China do this? And then I'll tell you how they do it in a minute, but let me tell you why they would do it first. First of all, trade happens through the exchange of money, and currency is as important an influence on trade as anything. It's as important as the traded goods and services that we're buying themselves. If a refrigerator costs $1,000 to import, and by the way, that's mainly what you get hit with, major appliances, cars, electronics. Those are the type of things that really get smacked around in trade wars. But let's say a refrigerator costs $1,000 and you got a 10% tariff suddenly. Now that same refrigerator costs $1,100. Well, some way, somehow, that person who just imported that refrigerator and paid $100 more for it is going to pass that on to you or someone along the way. Well, China knows that if basically we have increased their prices by 10%, because you put a tax on something, that's an increase, right? That they're not going to sell as much of it. And that's why we put tariffs on. That's the penalty, is that, look, Your economy is going to suffer, even though you're not the ones paying for it. Your economy is going to suffer because our people aren't going to have the buying power by 10% less. So what does China do? They say, well, okay, fine. We're going to make our currency cheaper, which means that you can buy for what it now costs you $11 to buy. Now you can buy for $1 or $10, and they artificially drop it. When governments intervene in currency markets to subsidize their imports, they violate the principles of free trade, and that's why this is important. So how does a company manipulate its currency? It's a policy used by governments and central banks and some of America's largest trading partners. We do not do it. But they artificially lower the value of their currency, in turn lowering the cost of their exports. That refrigerator goes down by 10%. You're going to add 10% tariff? I'm going to make it cost 10% less. I've just cut off the top of the blanket and sewn it on the bottom of the blanket. This gives an unfair advantage to competition, by the way. So simply explained, in order to weaken its currency, the country sells its own currency. So they go on that international currency market and they sell Chinese yuan. Now, just like the stock market, the only thing that causes a stock to go up, if you buy Apple, it means more people buying Apple that day than selling Apple that day. More buying than selling will create an updraft in price. Same thing in the currency exchange. So if they're selling their currency and they're taking the proceeds and buying US dollars, what's going to happen? They sell their currency, they sell their own stock, let's say, and they buy our currency, our own stock. Well, our stock, our dollar is going to go up and their dollar is going to go down. Their yuan goes down. Do you understand how that works? So in order to weaken their currency, they sell their currency while buying our currency. I sell my Apple stock while buying Texaco stock. Well, if you owned enough Texaco and Apple, you could make the Apple stock go down by selling it and the Texaco stock by buying it. Following these laws of supply and demand, the result is that the manipulating country reduces the demand for its own currency. He's flooding the market with their currency. They're selling their currency, right? There's more currency on the table now. It's worth less. Not worthless, but worth less. And now it increases the demand for our currency. You think, well, that's a good thing. Dollar's valuing. Well, not so much sometimes. I'll explain that in a second. So country X, China, sells its currency. They purchase dollars, and the value of China's currency decreases, providing a subsidy to their exports. Now, how do we know that a currency has been manipulated? Well, the International Monetary Fund, otherwise known as the IMF, or the World Trade Organization, have provisions to catch countries red-handed. And there's just two basic questions they ask. Did China have more exports than imports, an account surplus, so to speak, over a 6-month period? Number two, did their dollar reserves stay the same, go down, or go up? And it's pretty simple. When countries manipulate their currencies and unfairly lower the cost of their exports, you can see it from the outside. Country X weakens China weakens its currency, value of the dollar increases, exports are less competitive in China, and the U.S. exports to China decrease also. So, and by the way, too much of the currency. So let me tell you what happened. So they deflate their currency on over the weekend, and on Monday the markets crash. Okay. Well, the next day they said, well, and by the way, what that meant was, remember I told you the 7 yuan to $1 was the standard? They let it drop below 7. That was the big news, okay? The next day, Tuesday of this week, they came out and they said, well, we're going to set a floor just a little above 7. Markets rebounded, as you saw. Came back the next day and said, we're setting a new floor at 6.9696. The bond market got smacked around across the world because global instability. I mean, the two biggest economies are firing shots across the bow. That's why the market caved on Wednesday, then came back at the very end. But the reason China didn't keep their currency deflated, because you can't do it for very long. Currency deflation is a bad thing. It causes crazy inflation. Think about the peso just down south. It costs you 10,000 pesos to buy a loaf of bread, right? Used to be back in the 50s, it was about 1 to 106 or something like that. It also causes political instability. Keep in mind, China's got a very fragile economy anyway, and somewhat corrupt. So this can spell disaster which is why China set a floor Wednesday, which calmed the markets. On the other hand, why we care about our currency appreciating. It can lead to a fall in domestic demand because prices are higher. Everything's priced in US dollars, right? So when you buy our stuff, it's going to cost more because our dollar's worth more. Exports are less competitive. Imports are cheaper. For an economy which is already growing slowly, like China, a strong currency will worsen their economic slowdown. So they're feathering this thing as we move along here. And that's why we have this issue of the ebb and flow of the stock market. The reason that the stock market is affected by something like currency exchanges is really simple. It's just more global instability. It's just more global instability. And that's why it's so dicey. All right? And that's what drove the markets, by the way. Look, I mean, after much anticipation of what's going to happen at the end here, you sort of got to look at that chart of the Dow Jones, right? And you have to take a look at that chart and you have to realize, look, we have been going up for 10 years. We are crazy top heavy here. Even with pulling back a bit, we're top heavy. So we may as well, buckle up and sort of, realize that volatility is probably the norm for a little while. All right. Christina Gustin is going to join me here in just a second and break it down for us. I want to see what the money managers are saying about all this volatility, or if they're just keeping their heads down. It's San Diego Business Saturday. I'm Sully. It's News Radio 600 KOGO. News Radio 600 KOGO. San Diego Business Saturday is on the air. Coming up in just a few minutes, Patrick Dehaan with GasBuddy.com is going to tell you the cheapest gas in San Diego and what gas is going to do for the rest of the year. He will prognosticate and gesture wildly so you never have to pay full price at the pump. How about that? Kogo.com, keyword Sully is where you can find this broadcast. If you want to go back and listen to anything, if you want to listen to my explanation of how currency manipulation works, I'm more than happy to make that available to you. By the way, the television version of San Diego Business Saturday, shot from the Jump Television Studios in sunny San Diego, California, is available right after the program today by going to Kogo.com, keyword Sully. And we'll have to get Christina Gustin in studio at some point so you can place a face with a voice, although she's been on the air with us several times, as well as other media outlets here in San Diego. Things calmed down a bit after Monday's storm when the White House put an optimistic spin on the U.S.-China trade friction, where Larry Kudlow said the administration still expects Beijing and their negotiators to come to Washington in September. Well, that was good until the bond market got just rallied. I mean, just reeled worldwide, got slammed globally, and the Dow at one point on Wednesday was down 580 points. As I was on the air with LaDonna on San Diego Morning News this past week, I'm reading and saying during one of my hits that the Dow Jones currently down 380 points. And as I said it, I looked at the computer again and I had to correct myself and say, let me take that back. We're not down 1%, we're down 2%. And what's interesting is on Wednesday, we clawed back every single thing we lost. In fact, S&P ended up $2. NASDAQ was up 30 points. I think the Dow Jones was absolutely just even on the thing, but just really interesting how this entire ebb and flow is happening because of the China trade deal. But we're certainly learning a lot about foreign currencies, and we're certainly learning a lot about trade. And what I think the real lesson here is, the real lesson is how much of a global economy we are really in. We are not just the US of A. All of these publicly traded companies that we invest money in are doing business internationally, especially when it comes to products that maybe fall into the category of import-export. So here to talk about that today is Christina Gustin. She, of course, is Senior Wealth Advisor for UBS and RKG Wealth Management. And she is probably the smartest person I know in the investment game. I certainly trust her with all things financial and have referred her folks before, and I'll continue to do so just as long as you agree with everything I say, Christina. That's how that works here.
Thanks for that introduction. Good morning.
All you have to do is agree with me, and I'll keep on flipping your business over there. Hey, can you explain for the Johnny Lunchbucket and Cindy CEO listening right now how the bond market works and why there's an inverse relationship between the bond market and interest rates? I want you to explain it as if you were to explain it to a client that doesn't have a lot of investment experience. Will you talk about that? Because that was one of the reasons we saw such volatility this week in the stock market.
Sure. No, I'd love to. And we've been having this conversation a lot lately. And it's especially important this week. We've seen huge moves down in bond yields. As you said, the 10-year Treasury on Wednesday, I think hit like 1.6, which we haven't seen for a long time. So it means different things depending on where you are in, your phase of investing. To you as an investor, if you think about it in terms of supply and demand, if you own a 5% bond and someone were to go out into the market and the prevailing rate is 1.6, a bond with a yield of 5% becomes incredibly attractive, and the price can go up on that bond if you were to sell it, but I would advise you to hang on to it. However, if you're putting new money to work right now and you're getting 1.6, I mean, that's a historic low.
You're losing money at that rate against inflation, right? I mean, you're losing money against inflation at that point. I mean, you're actually throwing money away if you were to compare that with the inflation rate. Not by a lot, but by a little. And I think that's the danger here, right?
You are, and it's really interesting. So UBS, in our tactical asset allocations right now, is recommending downside protection for your portfolio in the form of long-duration treasuries. And if you look at, I think the yield on the 30-year treasury right now is close to or less than like 2.5%. So
and keep in mind, and I want to talk about that for a second. So when we talk about yield and we talk about rate, the rate is the amount we're going to make on our investment. The yield is the amount of money that turns out to be. And I think a lot of people confuse rate and yield. They interchange them, and they're not necessarily interchangeable. But what you're bringing up is this is a pretty significant moment in history, because this puts us teetering at the edge of a cliff potentially if you're a believer in technical analysis and a yield curve, correct?
Yeah, and that's a really important point that you make. We call that bond math, and we call it the coupon is the face interest rate. If you think about it like your mortgage, you have a 4% mortgage, you're paying 4%. But as we're trading these bond instruments, again, if it's a 5%, that's very attractive. So you're going to pay what's called a premium if you want to buy that bond in the market, which brings the return on your dollars down because you're paying more for that higher coupon. So that's the yield that we're talking about. Yeah,
and the interesting part of this yield curve is if you're a believer in bond math and such like that, it has somewhat reliably predicted stock market moves and such, but we don't buy stocks based upon just one metric, and that's the big piece here, is that when we see such swings like this, Christine, and you and I have talked about this for weeks here, when we're seeing swings in the market like we're seeing in this last couple of weeks, you can't just look at the one thing that's causing the market to go down. You got to look at the whole picture. And I think that's the lesson to be learned here, right? Because had people jumped out early morning Wednesday talk about Monday and Wednesday, when I think we lost 3% at that point during the week. Mm-hmm. Had you jumped out at that point, you locked in your losses in some cases. Now I realize you've got to have, and I think the lesson here, you have to have a strategy going in. Because some people jumped out because it was time for them to jump out, and that was their plan to jump out if those things happen. Other people just jumped out willy-nilly, and I think that's the scary part.
That's a really important point, is just having a plan and not panic selling. That's usually the worst thing you can do. And so, a lot of what I do is talking people out of making panic moves. But I think that the moves that we're seeing in the markets this week have been people asking the fundamental question, is the economy strong enough to withstand the next phase of this trade war, whatever that looks like? And I think China's playing a long game. We're playing a game of the length of a presidential term, 4 years, and they're in it for the long haul. So I think they have some additional tools that they can use against us if they want to. If this escalates.
Right, because the interesting part of this thing is they can play this manipulation game that I just described in detail as we open the show in perpetuity. Because look, they're not going to keep their currency deflated for long, and they're not going to keep it inflated for long. But they can certainly rattle all the global markets as a result of it. I mean, look, because trade happens through the exchange of money, currency, as I mentioned earlier in the program, is as important an influence on trade as the qualities of the goods and services themselves. And if a government will intervene in currency markets to subsidize their imports, then it turns upside down the notion of free trade. It forces the market to ignore normal pressures of supply and demand. As I beat the drum for free trade, as always, free trade supports U.S. exports. Free trade supports American jobs. But free trade in goods and services requires free trade in currencies. And that's the problem. This is like saying, I don't care if you raise your price on a truck because I'm going to pay you in monopoly money anyway. I mean, I think that's the best analogy I can give you. I mean, I don't care. Raise the price on my iPhone to $2,000. I don't care because I am going to print my own money on my HP printer. That's really what you're saying here, because suddenly it makes no difference. Because if by threatening a tariff, exports substantially could be increased by 10% price-wise out of China, all they do is they deflate their currency by 10%, and it null and voids the issue. So that's what we have to understand here, is that we all got to take a deep breath when this happens, because this is going to go on for a while. And at the end, I think a country with a economy as fragile as China is going to end up being the big loser. I don't think they could withstand a trade war with the U.S., but I think you're right. They're in for the long haul. We're trying to get this done next week. Ain't going to happen by next week.
And that's a change in expectations. I think that, I've been reading a lot of analysts saying they hope that this would get resolved, by the end of the year. And I think the way it's looking right now is that this could be a really long-term negotiation. This is going to be pretty drawn out. Although they're saying, it's full steam ahead for September. We'll see what comes out of that.
Well, and again, the funny part about that, Christina Gustin, by the way, joins us at UBS Financial and RKG Wealth Management. The reason that's interesting is we want a talking point as investors. We want to say, because look, we start over every day in this investing world. The auction starts over every day in the stock market. The fear and greed cycles start over every morning, 6:30 Pacific time, whereby whatever happened yesterday, we feel better or worse today. So the talking point is, well, they're going to still come to the table in September, so there's some hope. Yeah, market blips back. Right? I mean, that's the scary part. This is why you can't take a short-termers approach to this stuff, because A, you'll pull all your hair out. B, you couldn't possibly have a strategy. And C, you never know what's going to happen in the next hour. I think if you go back and take a look, I have a better idea, right?
That's true. This week more than ever, yes.
All right, Christina, thank you so much. Christina Gustin, UBS Financial, RKG Wealth Management. And again, if you want to get a hold of her, 619-557-4758. She is not a sponsor of this program. I use her because she's smarter than me and almost anybody else I've talked to in the money game. Get a hold of her. I've referred her my friends' money, my family money. All right, there you go. Coming up, Patrick Dehaan, GasBuddy.com. We're going to tell you the cheapest gas in San Diego, where you can find it. There's a couple spots. Going to tell you what's going on and how gas and oil prices are reacting to what's going on in the global trade scene. It is San Diego Business Saturday. I'm Sully, News Radio 600 Kogo.
It's gonna look like this year. Whoa!
News Radio 600 Kogo. San Diego Business Saturday. Sully here. What a tumultuous week on Wall Street this week, right? And something that we have not been paying attention to, of course, is gas prices, because oil dropped down to 52 at one point this week, 53, something like that. Pretty steady, even though remember, stocks suffered their biggest one-day decline of 2019 on Monday, as I mentioned earlier. China allowed its currency to fall to more than a 10-year low versus the dollar after President Donald Trump rattled the markets last Friday by announcing additional tariffs. So the rout was the biggest one-day sell-off in percentage terms for the Dow since December 24th. And if you take a look at a chart that goes back, you'll see a very clear dip at the end of last year. I'm not sure if we can get that up for our television audience. And by the way, yes, you're listening to us on News Radio 600 Kogo, right here in Southern California, San Diego, up to Santa Barbara, out to Yuma. But right after this program's over, if you go to Kogo.com, keyword Sully, you can watch San Diego Business Saturday on television, meaning that we tape the show for TV. But I don't know if you guys have that chart up, guys. But it would be great to sort of show what that dip looks like. Because, look, this is one of those things where if you look at the very end of 2019, or I'm sorry, the very end of the charts is 2019, but you look at the end of 2018, you see the big dip there. That's, and if you'll go back further, you'll notice that we're about where we were middle of last year. So there you go. But let's talk about oil. My good friend, Patrick Dehaan, from GasBuddy.com. GasBuddy, I don't know if Patrick knows this or not, but GasBuddy.com I've been using for as long as it's been around, probably for Patrick out there, but Patrick is the senior analyst over there and really the voice, for all intents and purposes, of GasBuddy.com nationally. And they basically have a gas price temperature map, and I know that we've talked about this before, but I wanted to bring Patrick on and talk a little bit. Patrick, with all of this tumultuous market action, with the bond markets, the trade talks, the stock market, does this affect in an ancillary way at all gas? Because gas is a commodity. I would assume gas ignores all this stuff, or does it? Talk about that a little bit.
Sure. Well, and thanks for having me back. But yeah, absolutely. It's not a great week to be checking your 401k, or wasn't a great week, I should say, to check your 401k. Bonds were down, everything was down, but that includes the price of oil. And that also then would factor in the price of gasoline, which has continued to move lower. Oil prices, like you mentioned, at one point this week touched $51. It looked like perhaps we were going to get under $50, but short answer, absolutely.
So it does affect it.
Markets affects this.
I didn't realize that, because I figured the reason I say that is because, look, gas is a commodity, right? Our oil is a commodity. And I think it is of interest to a lot of people that you see a response in something like oil and gas as it relates. Is it because of the global economy issues, or is it more of an American thing?
Yeah, no, it's certainly very much the global economy. You're talking about the two largest economies here globally, the U.S. and China, and there's a lot of oil demand between the two. And so if you send shockwaves through China and the U.S., the two largest economies, the two largest oil consumers, it's going to have a ripple effect on oil demand itself. And that's what the market is obsessing about. We're going into a time of year now. Summer's almost done. Fall is when we start to see demand go down. And if the economy starts to slow down, you're going to have a double whammy of lower seasonal demand and lower demand because the economy's slowing down. And that's why oil prices are tanking.
So here's my question. And by the way, we're speaking to Patrick Dehaan. Patrick Dehaan is the head of petroleum analysis at GasBuddy, GasBuddy.com. So we need a break here. Okay, so let's play out a scenario real quickly. Tariffs get put on major appliances. You go to buy a major appliance, suddenly major appliance is 10% more because tariffs are not paid by China. Tariffs are not paid by you and I. They're paid by importers who pass the prices on to us. So we're getting a kick in the teeth with respect to some prices on major appliances, cars and such. But has most of the country seen some relief in gas prices? Because I know here in California, specifically in San Diego, and if you go to GasBuddy.com and you search by city, and you go to, you can literally click on San Diego. I mean, believe it or not, it's preloaded in there for you. It doesn't look like we've seen any reprieve from years past, although we're seeing reprieve from the beginning of the year. And I think if I were to tell you today where the cheapest gas is in San Diego, it's at the Noil, N-O-I-L, on the corner of Cactus Road and Otay Mesa, where regular is $3.19 a gallon. And, of course, the Costco on Carmel Mountain always seems to be either the cheapest or the second cheapest, and today they're $3.33. But why is it? Is it just the fact that we have so many taxes on our gas, Patrick?
Well, that's a huge issue in California, absolutely. But keep in mind, as gas prices are going down, stations are still sitting on pricier gasoline in their tank. So they're not necessarily passing along the drop in oil, the drop in wholesale gas prices as quickly. And where we're going with that is that tells us that we have a lot of downward room to move in the price of gasoline. So don't be in a rush to fill up. Oil prices have plummeted. Gas stations are going to pass along slowly as they get rid of some of that pricier gasoline.
Well, Patrick, let's also remind everybody that the gas station is the tip of the spear. They're making the least amount of money. Those folks are trying to make money on chips and soda because they're not making any money on gas. Is that accurate? I mean, they're the ones who get yelled at when they're out there with the ladder changing the price on the street corner. But am I accurate on that business model? It does not favor the retailer, correct?
Yeah, that's right. The further you get to the pump, I should say the further or the closer you get to the pump, that is, the less margin there is. So yeah, it's the oil producers, the refiners that make all the money, whereas mom and pop selling gasoline make a few cents a gallon.
What do we need to know going forward into the winter months? Obviously, I hate to talk about winter when we're still in the middle of summer and where everybody's enjoying their summer vacation, but let's face it, kids start going back to school in a couple of weeks, and then right around the corner is the holiday season. So do things get easier in San Diego and Los Angeles and Riverside counties when that happens, or is there a winter blend, so to speak?
Oh, there is a winter blend. And as temperatures cool off, as the summer cools off and we revert to autumn and then winter, things do look better. We see lower demand as we head back to school. People are taking less of these road trips and vacations. So demand goes down. And slowly from north to south in California, as you progress through October, parts of the state start to switch back to that cheaper winter gasoline. So you get a natural break every fall. But depending on how this whole U.S.-China trade war goes, we could see prices 25, maybe even 50 cents a gallon lower by Thanksgiving. When it will start? Well, probably more so in October when that transition in California starts. But I think we could see some sizable relief by the time Thanksgiving and into Christmas rolls around.
What's interesting here, by the way, we're talking to Patrick Dehaan, who is a senior petroleum analyst at GasBuddy.com. In fact, he's in charge of the whole thing. Speaking of going back to school, yeah, it is almost that time of year again, and when the kids leave the house and head to school, everything else is expensive. But on your website, one of our listeners pointed out to me last time you were on the air that there's some consumer tools on there where that'll show you places around town where if you shop, you can get 3% gas back, 5% gas back from places like Staples and Old Navy and Michael's. So there's some resources on there for you guys in your blog because let's face it, you're not just a data company. You're also a company that helps consumers avoid paying full price. Is this a new point in the market to drive consumers into stores? Because let's face it, if you're talking about free gas, that's as good as cash back, right?
Yeah, it's pretty good. Nobody should have to pay full price on retail gasoline. And we have made some partners, like you've mentioned, that in our app, if you go to the savings tab, you'll be able to see that if you shop with some of these partners that we can pass along a discount on your next purchase of gasoline. And that kind of segues into the fact that GasBuddy also has a free payments card if you're not signed up. Currently, we offer 5 cents a gallon back when you use that payments card, which links to your checking account. So if you don't want to carry a credit card, our card will also offer you a discount. In addition, then you tie the partners into it, and you can start to get free gasoline. In fact, I built a deck this summer, and Home Depot is one of our partners, and I got $50 in free gas just by buying some supplies from them. So that's kind of a new avenue.
Patrick, before you let you out here today, and once again, if people want to go check it out, just go to GasBuddy.com if you want to check out what he's talking about and the gas price temperature maps. You can see an actual visual, price map where the redder the state is, or the redder the city is, or the redder the area is, the more expensive. We are purple, basically, in California compared to the rest of the country. In prognostication, 50,000-foot view over the next 12 to 18 months, what do you see with gas prices? Do you think that we're going to see a tightening of supply, which in turn causes gas prices to go up, or what do you think? Are we going to stay here for a while? I know it's a crystal ball, but I'm just going to ask you anyway.
That's right. Now, I would say that the U.S.-China trade deal may be some of the biggest clouds that we have from having a sunny view. I think we'll continue to be where we have been. I think there's a good possibility of an economic slowdown, and that would limit gas prices. I certainly don't foresee record prices, but I think next summer, if anything, we may see prices very similar to what we did this year. So no record prices. That may bring prices under $3.50 a gallon in much of California by this winter, only to go back up to $4 a gallon next summer.
So the more good news from Patrick Dehaan, head of petroleum analysis at gasbuddy.com. Patrick, thanks so much. Love to have you on the air as usual. Patrick's also a regular guest on the Big Biz Show, where you can find myself and Russ T. Nails, national TV, and of course radio, nationwide, coast to coast, and right here on the iHeartRadio app. It is News Radio 600 Kogo. It is San Diego Business Saturday. Everything you need to get through the rest of your week. I'll continue breaking it down here shortly. By the way, you can catch me every morning on San Diego's Morning News with Ted and LaDonna right here at News Radio 600 Kogo, as well as Good Morning San Diego and KUSI. Send me an email, would you? Catch me everywhere at Sully Speaks. Welcome to your weekend. San Diego Business Saturday is on the air. News Radio 600 Kogo. Thanks again to Christina Gustin from UBS Financial, RKG Wealth Management, and Patrick Dehaan from GasBuddy.com. I've got some news. I picked out some of the best stories through the week on the San Diego Morning News, and I'm going to come back and break them down for you as we continue. All right. I say we get right to this thing, don't you think? All right. So you can catch me every morning on San Diego Morning News with Ted and LaDonna right here on News Radio 600 Kogo. You can catch me several times throughout the week on Good Morning San Diego at KUSI, also their evening news, and I've got some news coming up for you on that coming up in a little bit. Also, The Big Biz Show with myself and Russ T. Nails. 22 years on the radio, 12 years on television, 110 million broadcast television homes, 150 radio stations, and also in 175 countries, because we also broadcast not only on iHeartRadio and the rest of our networks, on American Forces Radio Network. 175 countries and all the ships at sea for our military men and women serving our country overseas and underway. By the way, I want to throw out the fact that I will, for my 9th year, be riding my bicycle from San Francisco to San Diego in support of the Challenged Athletes Foundation. And I'm riding with Mayor Kevin Faulkner, former Chief of Police Shelley Zimmerman, and the usual cast of characters down the coast as we raise money for CAF. Challenged Athletes Foundation is an organization that provides adaptive sporting equipment to those folks in need of that, some of which have lost a limb in battle, some of which were born that way, some of which have had accidents. But long story short, if you are missing a limb and your insurance company is going to help you out to walk, they're going to pay for a walking leg. They don't pay for that special leg you need to run or the adaptive bicycle or ski equipment or surf equipment. And let's face it, look no further than the challengedathletes.org website to really take a look at, 4 out of 5 people with a physical challenge who've received a CAF grant are reporting an increased activity level, more happiness, confidence, emotional satisfaction, increased abilities by 98%. Anybody who gets a grant from CAF has increased physical abilities of almost 100%. So every year we ride our bikes from San Francisco to San Diego, 700 miles in 7 days, something like that. And we raise money for CAF. So I'll be taking off in October this year, October 12th through Friday, October 18th. And my challenge to you is to make a donation. And I will tell you, the person who donates, I've had you guys donate $10,000 before and show up in studio because they wanted to meet Bill Walton. I will tell you this, the person that donates $5,000 or more, and I'm going to speak on behalf of Mr. Mayor, will be able to have lunch with myself, the mayor, and the former chief of police, Shelley Zimmerman. And I will tell you because we have a team called Team Made in San Diego. All you need to go do is go to kogo.com, keyword Sully, send me an email, And if you want to make a donation, I'll send you the link so you can do so. We'll also put that donation link up at kogo.com, keyword Sully. But I'll tell you, any donation above $5,000 is going to get a private lunch with me and Chief Shelley Zimmerman, former chief, and the mayor, Kevin Faulkner. I should probably text them and let them know because I know one or two of you are going to do it. So there you go. Okay, let's get some news going because we had a couple of news stories, one of which was that cannabis stocks back in the news, but short sellers are increasing bets that cannabis stocks are going to fall. So a short seller, by the way, is an investor who bets against stocks. They bet that stocks are going to fail, and they've steadily been betting against cannabis. Even though there's been a rally in cannabis, they bet against them. We've had a rally in cannabis stocks since 2017. So basically, short sellers take a view on a stock that it's going to fall in price. They then borrow the shares so they can sell them. You realize stock is the only asset class that you can sell before you own it. It'd be like seeing a pickup truck on the side of the street, a red pickup truck, and saying, the owner of that pickup truck is going to loan this pickup truck to me. So while I'm having this truck in my possession, I think I'm going to sell it for $10K. I'm going to pocket the $10K, but I'm going to go find another red pickup truck and try to buy it back for $8K, and I'm going to pocket the difference. That's how shorting stocks works. They take a view on a stock that the price will fall. They then borrow the shares so they can sell them, hoping they can scoop up the shares later, return the shares to the original lender, and pocket the difference. Well, the cannabis sector has hit a summer slump following a series of scandals. CEO of Canopy Growth got ousted. There's regulatory deadlock. There's a federal banking problem. There's weaker than expected earnings. And then, of course, there's Canada, who has a federally licensed, nationwide legal cannabis, is putting downward pressure on the cannabis stocks. So the shorters are in, and they're betting against cannabis stocks. On Monday, as we talked about, when we had the biggest drop in a year in the stock market, Apple dropped 5%. 5% for Apple, and I think it's trading around $200 a share. But I started looking, and I know LaDonna hates when I do this, but I was looking at how much money we would have if we'd invested in Apple previously and just kept our money in. Because when Apple went bankrupt back in the 90s and then made their triumphant return by selling bright blue desktop computers, who'd have thought we would have wound up here, right? Apple became the first $1 trillion company August 2nd of 2018. And their stock passed, I think it was $207 a share or something like that. And again, right now it's currently around 200. By the way, the very first company, just a little trivia for you for the weekend, for your cocktail party tonight on Saturday. The first company in the world to hit the $1 trillion mark was an oil company called PetroChina. Very first company ever. But back to Apple, just so we can kick ourselves. Here's how much you'd have had you invested $10,000 in Apple years ago. If you'd invested when the Mac launched in 1984, that $10,000 today, had you let it ride, would be worth $3.8 million from 1984 to today. If you had invested when Steve Jobs returned to Apple after being ousted in 1997, that $10,000, the day that Steve Jobs came back, if you plunked your life savings of $10,000 on the table in 1997, you'd have $2.5 million today, just on that one stock. And even if you wanted to invest, well, let's say you waited until the iPhone came out. Can anybody tell me? Janicus, Curtis, what year did the iPhone come out? Any guesses? 2007. Isn't that interesting that the word iPhone was not in our lexicon 13 years ago? If you waited to invest in Apple until the day the iPhone came out and said, you know what, this company finally has something, and you plunked down your $10,000 in 2007, just 12 years later, you'd have $115,000 left. How about that? So if you want to feel worse about yourself, that's what you would have had in Apple. Local news, SeaWorld Entertainment. And again, I have been beating the drum for economic impact in this city for a long time, which is why I talked about a civic asset called a new stadium versus a Charger stadium, because that's really what it was. our economic drivers in order start with the military and are followed by a very close second by tourism. And tourism is affected by things like Comic-Con, Cabo Del Mar, SeaWorld, opening day at the races. Those things are so important to this city because, again, that brings in heads in beds in our hotel rooms. And heads in beds, just like when you go lay your head down in another city, we are charged a transit occupancy tax, or what's called a hotel tax. We rarely look at it, but it's why when you're paying $150 a night for a hotel, it's more like $175 a night for a hotel, right? Same thing happens here in San Diego. That TOT tax, those hotel taxes, are 1/3 of our general fund. In fact, it represents more than a third, but you've got property taxes, you got sales taxes, and you got TOT taxes that make up the general fund that run our city here. Well, SeaWorld Entertainment Group is beating the drum for our economic impact, and they are doing so well with respect to what they're doing for tourism. And just so we don't forget, the tourism industry supports 170,000 jobs in San Diego, and for every visitor, well, let me back up. For every 1,000 visitors, 3.7 jobs are required. Last year, close to $20 billion in economic impact was created for San Diego, and $8 billion in direct spending. This is why we have to know about economic impact and tourism. Well, SeaWorld showing no signs of retreat from a rebound that began early last year. Now, even though they recorded a 1% gain in attendance during the second quarter, visitation was up by 100,000. So the total number of guests during the quarter, get this, the total number of people that went and visited SeaWorld in the second quarter of this year, 6.5 million people during the quarter. Now, keep in mind, they're paying $15 million to the city of San Diego every year for rent. They're employing at full strength about 5,000 employees. And this is the 6th consecutive quarter of attendance gains by SeaWorld. So you got good revenue, you got everyone else. And look at SeaWorld even outperforming Wall Street in net income. So when you think in terms of what's going on with respect to tourism in this city, hats off to SeaWorld, whether you like them or you hate them. And I think they're, to get political, they're doing everything they can to placate any complaints that may come their way. SeaWorld's doing their job. All right, that does it for us this week. Thanks again to Christina Gustin with UBS Financial and RKG Wealth Management. Her information is at kogo.com, keyword Sully, or bigbizshow.com. You can find that. Also, Patrick Dehaan from gasbuddy.com, like the name says, gasbuddy.com. You can catch me at bigbizshow.com or right here every morning on the San Diego Morning News and Good Morning San Diego on KUSI and bigbizshow.com. Till next week, San Diego Business Saturday. Go enjoy your weekend. News Radio 600 Kogo.